This is the Scrap Metal Commodities Recycling Report by BENLEE and Raleigh Goldsboro Recycling, January 9th, 2017. Last week, commodity prices were mixed, while economic reports were mostly positive. U.S. steel production ended the year in a decline, driven by year-end holiday scheduled days off. Oil fell slightly to $54 a barrel, yet it is almost exactly double what it was 12 months ago. A huge rise, which is a key reason we are seeing nice oil patch jobs and steel used in oil drilling, as well as increased inflation. The oil rig count continues its slow rise at about 529 rigs, up an enormous 67% from just 12 months ago. Yet in reality, the count is down the same 67% from the 1609 rig count of about 2 years ago. The count in jobs are down significantly from 2 years ago, but the recent increases is supporting higher commodity use and prices. Note the oil price increase is heavily due to production cutbacks by Saudi Arabia and other countries, not due to the major increase in consumption that some think. Iron ore ended the week at $78 a metric ton, down $2 on the week, but similar to oil, it is up 111%, more than double a year ago. Increased global demand is a key driver for those increased prices, though. Scrap ferrous prices remain steady on this graph, but next week they'll be up about $35 a gross ton. Like iron ore and oil, scrap prices are about double what they were just 12 months ago. Hot dip galvanized steel remains steady at $850 a ton, but up $150 a ton from just a few months ago. Prices could rise further this month based on major increases in scrap and iron ore that we've seen in recent weeks. Stainless scrap 304 held steady at 36 cents, which was the new high for the year, on stronger demand, and there is word that price pressure will show increases in the coming weeks. Copper held steady at $2.50, which is showing stabilization after a major run-up in recent months driven by speculation. It's not clear if the slow increases in demand will keep prices at this level in the months to come. Copper is $2.53 this morning, though. Recent copper inventories have been declining, which actually should help stabilize these prices. Aluminum rose a penny to 78 cents, which is showing stabilization after drifting down in recent weeks. Aluminum inventories, which were recently near 9-year lows, have been rising in recent weeks, which actually could put downward pressure on the prices. U.S. non-farm payrolls increased by 156,000 in December, which was below expectations, but it's a solid number, and it's a very positive thing for the overall economy. U.S. construction spending in November increased by 0.9% versus October to $1.18 trillion, the highest level since April 2006. Private construction jumped by 1%, boosted by single-family home building and home renovations. Private non-residential structures and public spending also contributed to this. The Institute of Supplier Management's Manufacturing PMI, which is the Purchasing Managers Index, rose to 54.7 in December from November's 53.2. It's the highest reading since December 2014, as new orders, production, and employment all registered new highs for 2016. U.S. sales of vehicles finished up in December, making 2016 a new record high for any year. There is some current weakening with temporary plant closing and some shifts being taken out, causing some layoffs. Overall, though, 2017 could be a very good, not great year for sales and production of vehicles in the U.S. The stock market hit new record highs yet again last week, with a driver being in the payroll report we just talked about, which had wages growing the most in 7 years. Lastly, a special hello to Howard Overbuck, who is mostly retired, but we were told is a fan of this report. Howard, thanks for watching. With that, we hope all have a safe and profitable week.